This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
I have absolutely no statistics to back this up, but I'll bet a lot of smart, patient individual investors like you did better than professionals last year. Why do I say this? Because instead of trying to make bold economic forecasts that likely led to very bearish positioning, you stayed diversified, you stuck with quality, and you didn't panic and overreact to a lousy 2022. In short, and of course I'm being facetious here, correct simpletons likely bested mistaken geniuses. Up next, I'm not sure that changes this year. Let's discuss. Welcome on board another edition of our Wise Investor Group podcast. Happy New Year to you all. Hope you all had a safe, relaxing, and festive holiday season. Really excited to be back with you and engaged in what is a very interesting start to the year, by the way. Remember, we finished 2023 with a ton of momentum. In fact, the S&P went up 9 weeks in a row to close the year. I think that's the first time that happened since 2004. And what was particularly interesting about that 2-month-plus rally is that you started to see the equal-weighted S&P do a lot better. What do I mean by that? Well, we've talked all year. I mean, you've heard me on these podcasts for multiple months now talking about how the Magnificent Seven, those mostly tech stocks that had completely dominated the S&P, make up almost 30% of the S&P last year, how they were the only thing really working. And indeed, I think as of mid-November, the other 493 some stocks on the S&P were actually negative for the year. But again, over the last couple months, that's really changed. And in fact, since we saw the peak in interest rates, at least for the time being, since we saw the peak in interest rates, I think it was October 23rd, I believe, if you look at the 10-year Treasury. That's right after we got the inflation data that was cooler than expected. People started to now assume that at that point that the Fed was going to be out of the picture and maybe even cutting rates here in 2024. But again, from that time, October 23rd through this Wednesday, according to Securities, the equal-weighted S&P, i.e. sort of the average stock in the S&P, was up almost 16% over that 2-month period. The Magnificent Seven only, still look good, but only 11%. It's almost a 5% spread there. So in a period where the interest rates were falling, you saw the equal-weighted S&P up at least 5 percentage points better than the headline S&P, dominated by the Magnificent Seven. But what's even more interesting is just in the past few days, since December 27th through, I guess it was Thursday, also according to Securities, you've actually seen interest rates pick up a bit. Yet the Magnificent Seven has still underperformed the equal-weighted S&P by about 2.5 percentage points. So, in the short term, as interest rates have fallen and then gone slightly back up, doesn't matter. Equal-weighted S&P started doing better. So why am I bringing this up? Because maybe this isn't just a knee-jerk reaction to rates. Maybe this is something more systemic, secular in tone, that we may start to see some better performance from the average stock, and maybe there's the potential that 2024 will not be as top-heavy as most of 2023. So again, that's a very interesting start to this year. I'll be watching that very closely to see if that, has legs. But in the short term, I don't think it should surprise anybody that the markets have been skittish to start 2024. A couple big down days. Obviously, Wednesday was a pretty big down day. And that's because in the short term, swings are often determined by sentiment. When things tend to get too negative, as they did October of last year, that's often the setup for a bounce. When everyone feels a little too fat and happy, and I'm probably both coming out of the holidays, that's often when you get a turn to the negative. And if you look at the current sentiment indicators, whether you look at the American Association of Individual Investors bull to bear ratio, whether you look at the Investors Intelligence bull to bear ratio, consensus of money managers, whatever sort of sentiment indicator you follow, and I follow a lot of them, almost all of them at least came into this year in extreme positive territory. So it is not surprising at all that we've seen some steam come out of the balloon. Obviously, I have no idea, to what extent we're going to continue selling off, whether this is just a few-day thing or whether this morphs into a 5 or 10% pullback. Don't know that. But again, it's nothing that has surprised me in the least. And, going back to the Magnificent Seven for a second, it's also not surprising that they've pulled back a bit here to start the year. The Wall Street Journal noted recently, I guess this was right at the end of the year, that Apple, the market cap of Apple is equivalent to the entire market capitalization of Japan. The companies in the Japanese index, I should say, in the Nikkei. Think about that for a second. Microsoft, larger than the market capitalization of publicly traded companies in France. Alphabet, NVIDIA, Amazon, Microsoft, and Apple combined have a bigger weighting in the MSCI All-Country World Index than the UK, China, France, and Japan combined. So when I use the word behemoth, I'm not using that word lightly. That is an incredible amount of dominance from a market cap point of view, and I'm not saying it's not deserved. We've talked for months now about how a lot of that is backed up by the contribution of their earnings, the contribution of their revenues to the S&P, although I would say their market cap weight in the S&P is now significantly greater than their earnings contribution, which is another reason to think that maybe these things deserve to pause for a while. And then if you look at some of the individual companies, I'm a big fan of Apple. We've talked about how we own it for clients. I own it in my personal account, so you can decide if that represents a conflict of interest or not. But I'll just say one thing about Apple, that they didn't have a great year operationally. Their sales were down the year ending September 30th, 2023, over the last 12 months. Their expenses were up over the same period. Their operating income was down, and their earnings per share were basically flat. So Apple did not have a good operational year, yet they came into 2023, according to FactSet, trading about 21 times earnings, exited at 31 times earnings. So despite a lousy year, or at least a lackluster year, maybe is a better way to put it, their valuation expanded 10 percentage points. And that's why the stock ended up almost 50% for the year. It was almost entirely to do with multiple expansion. So think about that for a second. Would it surprise anybody if Apple paused for a while? And this is not a stock price prediction. We still have Apple in our portfolios. I still own it personally. I'm not saying you should go out and sell it. But, if you're overweight the stock or overweight the Magnificent Seven in general, I should say, maybe you take a look at that and say, hey, listen, is that right for my particular situation? As I always mention when I talk about individual stocks, it's very difficult for us to manage through the computer if you're not a client. You've got to do your own homework. Just a couple other notes on the Magnificent Seven, and this is along the lines of, just because the stocks may pull back a bit does not necessarily mean, it's a reason to panic or sell. If you look at the historical volatility on some of these, all of them for that matter, it's pretty stunning. I saw a chart. It was from Charlie Bolello, the financial blogger who I quote all the time on this show. He charted out NVIDIA going back to their 1999 IPO. A lot of people didn't even know who they were at that point. But it's amazing the drops that they've had. 2005, the stock dropped almost 92%, peak to trough, almost 92%. 2009, they had another almost 80% drop. 2018, about a 60% drop. Last year, do not forget, they were down almost 70%. Yet here we stand with major gains in the stock from inception to where they are today. And you could say the same really about any of the other Magnificent Seven stocks. If you look at Meta's total return in 2022, according to Charlie Bolello, was minus 64%. Had a huge year last year. Look at Tesla, down 65% in 22, almost doubled last year. So as the late Rick Malone would say, these are the fleas that come with the dog. If you are going to own some of these huge winners, and you hope that they're going to continue to be winners, you've got to be able to live with some of these huge potential drawdowns at various points, because that's been the case not just in the last couple of years, but going back to the Meta, Amazon, going back to the inception of these companies. So that's not a prediction for 2024. I'm hoping they don't have that type of drawdown, but it would not surprise me at all if some of these names took some time off in terms of share appreciation and kind of grow into their multiples. So think about that. I don't plan on doing a big sort of retrospective today on what happened last year, but I did want to make just a few points. One is just how different last year was from 2022. I mean, I think actually how bad 22 was is somewhat understated when we think about it. Because for a combined sort of the proverbial 60-40 portfolio, 60% stocks, 40% bonds, that has been such a classically good allocation over a long period of time, it was the third worst year ever recorded, at least in the last 100 years, for a 60-40 portfolio. This is according to Bloomberg. It was the seventh worst year for the S&P 500. It was the worst year ever in the last 100 for the Barclays Aggregate Bond Market Index, which is one of the main indexes for U.S. bonds. And, of course, it was the worst year also for the 10-year Treasury bond. So we're talking, a bad year of historic proportions. Of course, 2008, the financial crisis year, stocks did worse than 22, but bonds held up a lot better. So most diversified investors lost money, but, not as much as the stock indices. 22, bonds did almost as poorly as stocks, and bonds didn't help mitigate risk at all. Okay, that's 2 years ago now, so I don't want to go back too far, but that was 22. Well, think about last year, right? Almost everything reversed. Pretty much every stock, at least major stock index, made money. Now, again, if we were having this conversation in October, that wasn't necessarily the case. But with that rally at the end of the year, that last 2 months, you saw the Russell 2000, which is the small cap index, end up in the teens, the equal weighted S&P in the teens, the Dow in the teens, a lot of the primary international benchmark in the teens. And bonds, by the way, still were able to produce almost a 4% total return, which, again, was far from the case in August, September. Remember, the 10-year Treasury yield went from roughly 4% to about 5% late summer, early fall. Of course, prices go the other way. Looked like we were on track for the third consecutive year of bond losses, but that reversed in the last 2 months. So think about how different last year was. And I kind of bring this up because, as I said at the very outset, I'm betting a lot of professionals missed the year because the consensus this time last year, going into 23, was that the bearish environment would continue. In fact, the rally that we had at the end of 22 was dismissed by a lot of people. I remember Wilson, I forget his first name, but he's the main market strategist over at Morgan Stanley. And I don't mean to pick on him, but he was widely quoted as saying, "This is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do," end quote. What he was saying is don't chase the bump at the end of 2022 because it's not sustainable. We're going to have a bad 23. And that was a consensus. I mean, it was, in fact, in aggregate, according to Bloomberg, the first time in decades that Wall Street strategists saw a down year for stocks. And why was this the case? Well, it was because the macro outlook was so negative. If you look at just about any poll of economists, strategists, pretty much all of them saw a recession in 2023. And that's why they called for down stock markets and pretty good bond markets, because people thought that the Fed would be cutting and that rates would come down. So a couple lessons here, right? And I'm not here to bash Wall Street. I'm not here to bash particular or specific market analysts, because Lord knows there are a lot of smart people. But you got to be really careful, and this is particularly important, as we'll continue to say over the next 10 months, going into an election year where economic data, it tends to be politically charged, right? We all know Biden's going to use certain supportive data. Republicans will use certain data to, suggest that Biden should be out of office, right? And it's going to get polarized. So we have to be very careful with how much we read into macroeconomic data in general. But, just look at the last few years, right? And the idea that the bear market in 22 necessarily had to forecast a recession. But the reality is, according to Charlie Bolello, he went back 100 years. There have been numerous periods where we have had a bear market in stocks like we had in 2022 without a recession. In fact, let me count them up. 1, 2, 3, 4, 5, 11 periods. 11 periods going back, again, 100 years where we've had a bad market, bear market, but no economic recession. So people were a little too convinced about the relationship between bad stocks and a bad recession, not to mention that they were wrong about a recession in the first place. So again, it's a really good lesson going forward, because even if you can predict what the economy is going to do, it doesn't necessarily mean you're going to be right on the markets. So let's say we did have a recession and people predicted that. That doesn't necessarily mean that the stock market would have been bad all year. The relationship between stock prices in particular and recessions are not, there's no direct correlation in terms of the timing. The timing of those things are rarely in sync. Often the market sells off way in advance of a recession and recovers way before the recession is over. Also, it also depends on what type of economic data you pay attention to. So, for example, last year, if you got kind of earnings right and inflation right, if you predicted that inflation would come down, if you predicted that earnings would bottom and then start to pick up in the end of the year, you probably got the market right. But if you keyed off of other stuff like the dollar and credit spreads and Chinese stimulus and who knows what, chances are you would have been overly bearish in your positioning. So, I don't want to belabor the point too much. I think you know what I'm saying. As we look forward to 2024, let's not get too caught up in either the data as reported or our expectations of what the data might be going forward. Okay? So let's think about 24 a little bit. And of course, I come into this year very humble, based on what I just said. You saw how wrong people were about 23. They could be just as wrong about 24, and I'm very, very cognizant of that in terms of how we manage portfolios here. One thing I mentioned a couple weeks ago, and I'll mention it again, there's this kind of feeling that after such a good year for most asset classes that it can't last, right? That what goes up has to come down. Well, let's take a look at what the data says. I read a really good piece from Ben Carlson up at Ritzold Asset Management. I quote those guys a fair amount. And he looked back, I think he went back to 1928 and looked at the annual returns for the S&P to find times when big gains were followed by more big gains, when success begat success. Specifically, here are the double-digit up years that were followed by double-digit up years. And this lends itself more to a slide than a podcast, but suffice it to say, there were almost 15 separate clusters totaling about 40 years. So that's 40% of the last 100 years, right, roughly. 15 separate clusters where you had a string of double-digit years in a row. And, of course, the most recent one was the 2019 through 2021 stretch, right? Those were 3 years where the market had a double-digit return. The median returns, according to Carlson, for the S&P in the ensuing year following gains of 10, 15, and 20% or more are respectively 11.4%, 13%, 11.4%, with gains most of the time, at least 2/3 of the time. So, as the old disclaimer on every single investment you've ever bought, past performance is no guarantee of future success. As that disclaimer, suggests, this means nothing going forward. But to think that the market automatically has to calm down and sell off, and you might even think more of that, based on the first few days of the year, is not the case. It's just not borne out statistically, and is not borne out in multiple periods going back 100 years. Just a couple other factoids I just want to leave you with here with respect to how we should think about this year. There was, remember, of course, we're in an election year. Carson Group's Ryan Dietrich said the other day that stocks have been higher during an election year of a new president going back to the past 10 presidents. Even the historically strong pre-election year can't say that. So it's been higher the past 10 times and up 12.2% on average. So that's pretty, bullish for this year, expectations of this year. What's more, if you look at the last few years, remember, the S&P still has not gotten back to where it was at the all-time highs, which was early January of 22. So despite last year's very strong rally, we still haven't made up for the losses in 22. But as Carson Group noted, when stocks have dropped more than 10% like they did in 22 and jumped more than 10% like they did in 23, the following year tended to be pretty good, 6 out of 6 times, with 11.7% gain on average. And it's only the 11th time this year, going back to 1928, when the S&P ended the prior year with a gain, yet was still basically flat to negative over a 2-year period. Whenever that's happened, again, this is according to Ryan Dietrich, in the ensuing year, which is this year, the S&P posted a median gain of 12.5%, up 9 out of 10 times. So, I mean, and you can think about that intuitively. When the stocks don't go anywhere for 2 years, when you consolidate a major economic or financial asset class like that, chances are you're in store for some better gains going forward. So I think that's a really important point, though, because everyone's talking about how last year was a double-digit year. Maybe it's not sustainable, but if you look at things, if you widen the lens, we haven't gone anywhere in a couple years. The market has really, in some ways, grown into those potentially excessive valuations, coming out of COVID. If we get any sort of earnings pickup over the next 1 to 2 years, I think the markets, could end up doing a lot better than people think. As I noted at the top, using history as your guide, quoting some of these statistics, and then ending up with a somewhat bullish conclusion never makes you sound smart or sophisticated. Remember, the people that always sound the smartest are those poking holes. These are things that you're not seeing. This is the forest through the trees that you're missing. Whereas people who are bullish or optimistic, they're labeled as simpletons. But as I said, I'd rather be a correct simpleton than a mistaken genius. Those clients who stayed patient, who didn't get too caught up in what happened in 2022 and panic about 23, or they kept their allocation, because remember, a lot of the things that did the worst in 22 ended up performing very well in 23, and of course, vice versa. So far here in 24, a lot of the things that did best last year have been worse so far this year. Staying diversified has actually paid off for most people, because we don't know, obviously, what's going to cause the next market decline, because if we did, the market would already be pricing it in. So that isn't to say we should go in, not worrying about risk. Of course, I'm not saying that. There's a lot of things that could go wrong. But to think that we know what those risks are going to be, I think is a fool's errand. So that's why I say let's enter 2024 with a great deal of humility and flexibility and be willing to adapt to what happens. I know that sounds a little vague, but I think that's the approach that you have to take in this type of environment. But what are some questions? I do want to identify some things that we're going to be focusing on that you may already be focusing on, but if not, maybe it's something that you want to pay attention to. Probably the biggest one is what I just said. What is something that people are generally certain about that will ultimately be proven wrong, right? Coming into last year, as I just mentioned a few minutes ago, everybody thought we were going to be in a recession. Ended up not being the case. What is consensus du jour now, right? It's the fact that we're going to have that proverbial soft landing, that the Fed's going to be able to cool inflation, bring down interest rates eventually without triggering a significant economic downturn. That's what a soft landing means, okay? And that has become sort of consensus. So what about this consensus could be wrong in 2024? That's something we're going to be paying attention to. And what comes with a soft landing? There's been a lot of talk about the soft landing, but no one's actually talked about what that actually means. What happens if we see a resurgence in inflation, for example? What happens if housing prices rebound, stock prices rebound, people feel better about the economy, consumer sentiment picks up, and that brings in higher prices again. What happens then? That's something that we're going to be watching. It's certainly not a foregone conclusion that the Fed is done tightening, and Chairman Powell, as evidenced by the Fed minutes that were released this week, they feel the same way. They haven't taken further rate hikes off the table. And related to that is what's priced into the market. Has the market already priced in 3 to 4 rate cuts in 2024? Have we already priced in lower interest rates? The point being that if we do get those things, maybe the market doesn't react all that much. And if we don't get those things, like maybe we get more inflation or we get fewer rate hikes, maybe that becomes a headwind for the market. So again, I'm not citing these things as reason to panic or to sell, but just things that we'll be watching. And of course, is high inflation done? You know, the problem with inflation is there hasn't been a lot of inflation in the past 70, 80 years, right? So we just don't have a lot of historical evidence, to refer to. There was a significant amount of inflation coming out of World War II, right? As government spent a ton of money to rebuild the economy and put GIs in homes and all the rest. And then, of course, the 1970s. The inflation in the 1940s fell precipitously. The inflation in the 70s did not, right? It rose, then fell, then rose again. And that's the thing that Chairman Powell is really trying to guard against, is a resurgence in inflation. Now, the current data would suggest that inflation is under control. The core PCE price index, which is the Federal Reserve's preferred inflation gauge, is near their target level of 2%. So anybody who's telling you that, inflation's much higher than government statistics suggest, I'm not sure that's the case. Yes, inflation's a lot higher than it was in 2019. Prices are probably not rolling back to those levels unless we have actual deflation, which would only come most likely with a deep recession. So we're not going back there. But on a year-over-year basis, inflation has cooled significantly. So we'll see. On the face of it, the surface, inflation is coming back, but I think it's too early to declare victory. Another big question for this year is what happens to all the cash on the sidelines? According to Y-Charts, there's currently about $6 trillion with a T, in money markets. And a quarter of that came in just last year. If you look at the 30 mutual funds with the largest inflows last year, 25 out of 30 were money market funds. So there is an avalanche of cash. And so I think there are two open questions. What happens if the Fed does cut rates, and let's say all of a sudden those money market rates go down to 4%, 3%, 2%? Does it stay there, or does it go somewhere else? And does it go into risk assets? Another open question. In other words, is this money that's going to stay in cash, that people are going to stay risk adverse and say, oh, shoot, I missed the bounce in 23. I need to wait for a pullback to get in, or does it eventually come in to risk assets like stocks and bonds, or real estate for that matter? Open question. Can the consumer keep it going? 2023 was a much better year for the consumer than I think just about any economist thought. With all the pent-up savings during COVID, plus all the government assistance during COVID, once that was spent, a lot of economists thought that the consumer would kind of roll over. That has not been the case. Not been the case at all. And I think a lot of it has to do, in my opinion, with the fact that people, for the most part, obviously there are exceptions, but in aggregate, the consumer came into this last 12 months in really good shape. Balance sheets have largely been repaired now from some of the misery of the last 12 to 15 years. A lot of people own their homes outright, and a lot of people that have mortgages, almost 2/3 of the people who have mortgages, are financed at 4% or lower. So debt-to-income ratios, debt service measures just across the board are the healthiest they've been in some time. And yes, credit card delinquencies, some things like that have started to tick up. But things like it seems to me that we're kind of rolling back to 2019 levels. We're normalizing. We're not getting incrementally worse than where we were a few years ago. So can the consumer continue to spend this upcoming year? That's something that we're going to be watching very closely. I think the last thing I would just say on this front that I'm going to be watching very closely is corporate profit margins. And this may be the most important of all. And this is something I've talked about a lot. It was consensus on Wall Street that profit margins, bottom line corporate profitability would really suffer in 2023, mostly due to higher interest rates and the continual sort of negative impact of supply chain disruptions. And it is true that a lot of companies were able to raise prices 2020, 21, 22, and pass those prices along to the consumer. But, again, a lot of economists thought that would go away, essentially, particularly if consumer spending was pressured. But that didn't happen last year. Despite higher interest rates, despite lower commodity prices for the most part, companies were able to maintain that pricing, and were able to significantly reduce their cost structure. So whether that's through just running leaner and meaner coming out of COVID, more people working from home, less real estate, maybe that's harnessing artificial intelligence, AI, who knows? Bottom line is the level of corporate profit margins has persisted. And what that has created and will create is a tremendous amount of operating leverage. And what I mean by that is when you're very efficient, when you're very productive, when your expense structure is low, any sort of incremental pickup in revenues, i.e. sales, tends to be a multiplier effect there. That's what positive operating leverage means. So again, still plenty of macroeconomic risk this year. It's certainly not too late for the economy to go into recession. Can't rule that out at all. But if we do see some improvement in the top line at some point this year or even in 2025, I think companies are well positioned to translate or convert those additional sales, those additional revenues into significantly higher earnings. So that's what I'm going to be watching to see if that persists, and we'll find out fairly soon as we start to get the fourth quarter earnings. So stay tuned. Stay tuned for that. Next couple shows, I think we'll have more company specifics for you. I do want to talk briefly about a new addition to the portfolio. Stay tuned. Back in a minute. Don't be forced to sell stocks in a bear market. Now is the time to review your financial plan and determine how much liquidity you truly need. I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know about them. To learn more about how to manage your cash flow and to become a better informed, wise investor, listen to the Wise Investor Show at thewiseinvestorgroup.com or find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to our Wise Investor Group podcast. So for many of our clients, for the portfolios where it was suitable and appropriate, we added a new position this week. My caveat, as always, is that, well, as I'm suggesting, this is a name that we now own in many of our portfolios. I also own this name personally, and you can decide yourself whether that constitutes any sort of conflict of interest on my part. Remember, if we do buy it for clients, you can assume that we've put in a lot of homework, a lot of research, a lot of due diligence, and feel it's appropriate for those portfolios. If you're not a client, you really have to do your own homework to make sure it fits what you're trying to do, what you're trying to accomplish, your goals, and your suitability. But the name is United Health Group, UNH. It's a Dow Jones component. In my mind, the leading health insurance / services company, maybe in the world, but certainly here in the United States. Very well diversified. Their flagship United Health business, which is, I think, about 77% of sales, 50% of operating income, according to FactSet, provides commercial and government healthcare plans. So that's probably the one that you're most familiar with. you may have United Health insurance. I certainly do here at Raymond James. But then they also have their Optum RX segment, which provides pharmacy benefit manager services. That is a growing business. Optum Insight, which provides tech and data-focused consulting to players in the healthcare business, also a fast-growing business. And then Optum Health, which is a more recent business for them that provides direct care through local medical groups to better manage health on sort of the local level, so that including things like ambulatory care, mental health care. So that's sort of a newer business for them that is growing pretty quickly. So as you can probably guess, they are uniquely positioned within the U.S. healthcare system. They are, I would say, the leading insurer of scale across Medicare, Medicaid, and commercial markets, which is really a differentiator for them. They have a diversified income stream, and diversified in terms of, for those reasons, in terms of their economic exposures too. There's certain elements of their business or parts of their business that can do well in certain economic conditions, i.e. interest rates, pricing environments versus others, which has translated into incredibly consistent performance. If I'm being honest, and I always try to be honest, we should have bought this stock years ago because they've been not only a superior operator, but their stock has done very well. I mean, over the past 20 years, according to FactSet, they have never posted negative sales growth. Even during the financial crisis years, COVID years, never posted negative sales growth. In fact, it's been at 6% year over year or better 19 out of the last 20 years. And they've never had a loss on operating income. As a result, their stock has done pretty darn well also. So that type of consistency you just don't see with, at least I haven't seen, with most of the other players in the healthcare industry. In terms of what they actually do, they are the market leader in Medicare Advantage, which is an end market that I think pretty much everybody would expect to grow substantially just due to the aging population. But it's only about a 50% penetrated business, according to a report I just read from actually our parent company here, Raymond James. So there is a pretty good opportunity for United Health to expand the presence there. The Medicare Advantage itself is supposed to grow at about 8% a year, and UNH has consistently taken market share from others particularly over the last decade or so. In terms of some of their other businesses that are really attractive, I mentioned Optum Health. That's the sort of the localized, what they call a health and wellness business that provides direct care through local medical groups. That group, not only are they growing at a mid-double-digit percentage at this point, at least they have over the past 3 years, but they've also seen a pretty nice uptick in margins over the past 3 years. If you look at some of their other businesses, particularly Optum Insight, that's a consulting business that they have. That's also a mid-double-digit performer. And the analyst at Raymond James expects that to continue over the next few years. Optum Health is also expected to grow at about 20% year over year. So their legacy United Health insurance business is not going to grow that quickly, but some of these newer businesses are really providing the growth engine to what United Health is doing. And also what the macro environment is supportive of what they're doing. What we've started to see in U.S. healthcare, according to a piece from J.P. Morgan, is the reimbursement model. The way that medical providers are reimbursed is starting to change, where medical providers are starting to get a consistent fee per patient rather than a fee based on service or particular treatment. Maybe doctors don't like it, but it provides a tremendous amount of consistency and predictability in terms of what the earnings and revenues will be from a particular patient, which I think ultimately supports a higher multiple for United Health. So, I think you have a company that has pretty good visibility in, again, according to them at their recent investor day and according to the RJ analyst, into low double-digit earnings growth over the next 12 months. Obviously, there's no guarantees that will happen, but that's what the company believes is a conservative target. But I will tell you, the valuation seems to reflect something well short of that. So at today's prices, they traded about 19 times earnings, give or take, according to FactSet, which, again, according to FactSet, is not particularly cheap for them. It's essentially in line with where they've traded over the last 3 years. So I'm not going to sit here and tell you that United Health is a bargain basement valuation at 19 times earnings. However, if you kind of do the math, that implies about 6% annualized earnings growth, bottom line earnings growth over the next 12 months. Well, United Health, in their recent investor day just a few weeks ago, is calling for almost twice that growth rate, as does the RJ analyst, the Raymond James analyst. So, anything can happen. Maybe we have a bad economic downturn and unemployment picks up significantly and they don't hit those targets. That's certainly a risk factor here. But if they are able to deliver, and historically United Health has been conservative with their modeling and their projections, it implies that United Health is trading at a pretty reasonable valuation given their prospects and their consistency. The risk factors are fairly obvious. I just mentioned one, a potential significant economic downturn. They also are facing some margin pressure in their Medicare Advantage side, which so far they've been able to offset with really good margin improvement in their other Optum businesses. I mean, a lot of that has to do with the fact that, during COVID, people didn't go out and have obviously they would go out for emergency procedures, but they deferred physicals, trips to the discretionary trips to the doctor, cosmetic procedures. Well, the last 12 months, everyone's returned to the doctor's offices and had all those things done. That tends to compress their margins. But as I think things normalize and we get back to sort of a regular rhythm, if you will, of doctor visitation and medical expenditures, I don't think that's going to be a huge drag. But that has been a drag in the short term. Biggest risk out of all these things, I think it's just political risk, right? We're obviously in an election year now. There is no bigger political football than healthcare, specifically managed healthcare. We all remember all the dispute around Obamacare, both when Obama came out with Obamacare and, of course, later with Trump talking about having his own healthcare plan. We all remember Bernie Sanders talking about a one-payer system. These types of things come up in election years. I do think that this election year, there's less on the table, there's less of an agenda than in past years. Some of the issues are more around our foreign policy, around immigration, around abortion, taxation, those types of things. Healthcare doesn't seem to be as much of a priority as it has been, but we can't rule out the fact that UNH and other healthcare stocks, particularly managed healthcare stocks, aren't volatile here in 24. So there are definitely risks to the story. But if you are a long-term patient investor like me, and remember, I own it personally, we just started accumulating it in many of our client portfolios, it might be worth the risk-reward trade-off. Hope that was helpful. As I mentioned, Chase and I, over the next few weeks, I'm sure we'll be delivering more company-specific news for you as we get the fourth quarter earnings. Until then, again, I wish you a happy new year. And of course, as always, wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.